Thank you for joining us to learn about the Invico Diversified Income Fund. I'd like to welcome Jillian and Jason from Invico, who are here to teach us about this investment option and why it might be a fit for your investment portfolio. If you have any questions about this offering following the presentation, please reach out to your Raintree Private Wealth Advisor. And with that, I'll turn it over to Jason to get started.
Thanks very much, Corey. My name is Jason Brooks. I am the president of Invico Capital Corporation. I'm proud to present the Invico Diversified Income Fund today, which has been delivering results to Raintree and your clients for over 8 years. Jillian, let's scroll through. There are some notices here that should be read in conjunction with speaking to your advisor about this product. So just to get started, the Invico Diversified Income Fund, as I mentioned, over 8 years of delivering results, and we've been a long-standing issuer with Raintree Financial, and we are an award-winning private debt fund, and we're really an income fund that is diversified and focused on providing a rate of return back to our clients, which is sustainable and has been met over the last over 8 years, as I discussed. We have over $378 million in assets in the fund. That's as of April 30th. We have a target distribution rate of approximately 7%. That works out to just about 6 cents per unit per month on the Class B units that are available from Raintree. And we have almost now 9 years of performance. And recently, we concluded our 100th consecutive month of distribution paid to unit holders. I'd like to point out here that the fund has never missed a distribution to unit holders. And it's available for both accredited and eligible investors. And if you don't know what that means, your advisor can help you. Next slide, Jillian. So what are the key highlights coming out of the first quarter? And a lot of these highlights will be reaffirmed in the second quarter as you understand what the fund's about. Strong commodity pricing. The IDIF, and I use IDIF as the abbreviation, is a commodity component of our fund that is priced in natural gas and oil. We have natural gas and oil production in the fund. Obviously, this has been a very strong quarter in the first quarter and in the second quarter as well. So one of the things that we have been doing is, because of this additional cash flow that the fund has been earning, we're actually recording income at a rate higher than the 7% base distribution that we normally pay out on the fund. So in the first quarter, we announced that there would be an additional distribution for unit holders of record as of March 31st. That was 50 basis points or 0.5%. And that's paid after the quarter end, about 60 days after the quarter end. Given that oil and gas substantially in the second quarter, we expect to be able to repeat additional distributions in the second quarter. So with the 9th year of fund operations, our since inception annual compound return is 12.5% on a Class B unit. That is a seasoned 9-year number, and we're very proud to have a double-digit return. That's inclusive of both the income distributed as well as any gain or loss of the net asset value of the Class B unit. In addition, as we are all facing substantial inflation in our lives, this fund is an ongoing hedge against inflation. Obviously, the commodity component of this fund has been doing very well as those assets the prices for those commodities has substantially increased with inflation. So what you get here, though, is true cash flow to offset those costs in your life that are going up by way of the additional distributions that I mentioned. So we're going to talk a little bit about Invico. We are a firm that's been around for over 16 years. We manage 7 different funds, flagship being the Invico Diversified Income Fund. Over almost $1.8 billion of assets under management, all of it in private capital markets. So we are a reasonably sized firm. 41 employees. I think this is a little over date. We've been continuing to hire, so I think we're going to be close to 45 here by the end of June. And as I mentioned earlier, we've never missed a monthly distribution. And as importantly, we've never missed a quarterly redemption request since the inception of the fund. And we do offer quarterly redemption or liquidity to our unit holders. And ESG is a is a focus of the firm. Obviously, since we started, that's become a significant theme, I guess, in investing. And in backing that up, we are part of the 30% club, and we have annual charitable donations programs. Thank you. Let's move ahead. Alison Taylor is our CEO and co-founder. Her and I started Invico over 16 years ago. She's run a tremendous amount of rewards over the last 5 years. Recently in 2021, she was named Canada's Most Powerful Woman Top 100 Award. And that was in the Executive of the Year at the Wealth Professional Awards. She's a member of the University of Calgary's Investment Committee and Exempt Dealer Advisory Committee. And background, as far as her educational background, was an MBA in finance and an honors in actuarial science and actuarial science and statistics from UWO. My background, I've been 25 years in private equity and debt financing. I am responsible, along with Alison and Chris on the right there, for the Invico Diversified Funds investment decisions. I am a registered portfolio manager, as Alison and Chris are on this slide. And my background is I'm a Bachelor of Commerce out of the Haskayne School of Business. Chris is our Chief Investment Officer. He has over 30 years experience in financial services, so he is a critical part of our investment team as well, focused on obviously the bridge loan portfolio and overseeing the energy portfolio as well. He's a CPA by way of the original CA and a CIFA, and along with the fellow alumni from University of Calgary. Thanks, Jillian. We'll move ahead. So in addition to the senior investment team, we have the balance of the team here that is made up of, really, there's two sides of our business. We have, and you'll see this in the portfolio, we have a bridge lending or private debt component, private credit, and we have an energy component. So the private credit component is handled mostly by Chris and David Hawkins. And then the energy component is under the leadership of Kurt LaBelle. And in addition to that, you can see the other senior team members we have there with Sarah Pettigrew, who's also an engineer supporting Kurt. It's very important in the energy side of our business that we have the technical resources, which both Kurt and Sarah have tremendous depth on the technical side. Sarah joined us a couple of years ago from Waterous Energy Fund, where she also practiced on the acquisitions of energy assets. And then Megan and Rochelle on the right there, both supporting Chris and David Hawkins on mostly underwriting. So ESG stewardship, as I mentioned earlier, this is a core component. We are a signatory of the Principles for Responsible Investing, the PRI. ESG is integrated into our business. Yes, we do not apologize for producing energy. We produce, in our opinion, with a majority of natural gas, the critical commodities in an ethical manner that's under the governance of significant North American players, and they all have GHG reduction initiatives. In fact, some, such as Whitecap, which is a partner in some of our production, actually has a negative environmental footprint now with respect to their carbon sequestration that's underway. So we are proud of our record on environmental, and that extends into the often forgotten social and governance aspect of ESG, which are obviously clearly were overlooked by a number of ESG investors and are now becoming as critical of factors. Obviously, on the social side, we talked about our individual employee welfare being very important to us. We support new Canadians by paying 80% of their costs to recertify as necessary in their equivalent Canadian designation, particularly important on the accounting side. And we have a long-term track record of doing that. As I mentioned, or sorry, I don't know that I did mention this, but we are a signatory to that 30% club and we're both diversified in ethnic and on the gender side, 60% or better of Invico's employees at all levels are women. So we're proud of that track record. Governance-wise, I'm going to go through this later in the slide, but we are actively managing and governing this portfolio in a couple different layers of independent review as well. So our fund is a diversified portfolio of real assets and lending strategies that's important to understand at this stage of the presentation. So what is driving things right now? Obviously, the energy working interest there being a core part of this portfolio on the bottom left has been a very important growth in the portfolio over the last couple of years. But lending strategies and private lending in particular has been a core as the largest component of the portfolio, targeted between 50 and 60%. And given the performance in Q2, we're expecting to see some significant additional distributions continue to be paid out of this fund. In addition, here is where I can speak to some of the additional hedging we've done recently with the high prices on both oil and gas through to the end of 2023. So the fund is in a very unique position as having a lot of visible distributable cash flow through to the end of 2023 and beyond. We can move ahead here, Jillian. So our lending strategies, as I mentioned, this is the largest portion of the fund. This is a core strategy since the fund's inception date of 2023. We added the energy assets at the end of 2014 into 15 and have continued to do so. But on the lending side, our target loans are between 3 and 30 million. Terms are generally 1 to 3 years. The 60 days there is very rare, just be for short-term receivables financing. And our interest rates are about 10% or better across the portfolio. The portfolio itself is made up of corporate bridge lending, which is really short-term loans that corporations often utilize going 1 to 3 years to assist them in meeting their needs. Mortgages, obviously, everyone's familiar with the mortgages, and that is predominantly made up of multifamily residential properties in this portfolio. And some of the attributes I think it's really important to remember here is we focus on cash pay loans. We do not take payment in kind. That is a concept that's often out there in high yield lending, where you'll take equity in a company instead of actual cash interest. Our focus in this portfolio is 100% cash pay, and we achieve that currently across 97, about better than 95% of the portfolio. And we're predominantly a first position lender with asset-backed opportunities that we incorporate into the fund. Energy working interests. As I mentioned, this is a unique strategy. I want to point out here that we are not an operator of energy assets. We operate less than 5% of the energy portfolio, and is a very large position across both the US and Canada of non-operated working interests. So we get both a portion, we have 2 different types of structures in the fund, where we have either royalties or we are an actual non-operated partner, which means we get a percentage of the operating income, and we have the opportunity to continue to invest in those lands that we hold working interest on. Why do we like being a non-operated partner on assets? Well, the answer is there's several answers to this question. Firstly, low overhead and administration costs. We have approximately 5 full-time equivalent people in the energy side of the business, and we manage almost 3,000 barrels a day of production, which is a fairly sizable amount. Typically, if we were to have to operate those assets, we'd probably need between 40 and 50 people, not including some field staff. So clearly, this is a much lower overhead structure than typically would be found as a way to get the cash flows of this business out to everybody with the least drag possible. So that's a clear benefit to what we're doing here. We are focused in non-operated as well because we're able to get better economics. Typically, these types of opportunities, there's very few buyers in the market. Obviously, energy companies want to operate the assets that they own, so they tend not to buy non-operated interests. So in our case, we are looking at the mid-market opportunities, and there's not a lot of competition, which means we can give you better economics because we're paying less for assets. So the price per pound of cash flow that we're able to buy these assets at is generally less than what an operated asset package would go for. So it's a lower cost of entry, shorter term payouts, and stronger returns. Obviously, our joint venture partners are large companies, and they share they really manage these assets. As I mentioned on the ESG side, for instance, in Canada, our largest partners are CNL and Tourmaline. So they are clearly doing their job when it comes to ESG. Now you can jump ahead, Jillian, thanks. So energy working interest in action. Just so you understand, the operator generally controls the vast majority of these wells on the lands that we share. And IDIF is generally a minority partner, or is always, I should say, a minority partner. So as a non-operated partner, we're simply a financial participant bringing the wellhead economics through to you. And so this slide simply illustrates on any given well owners that have interest. And then in IDIF's case, our average interest across all of these lands is always under generally 5% of the wells that we're taking. It varies, obviously. Some are very low interest, some go up to almost 10%. But on balance, I think the fund is about 3% in this slide here across the average interest on a per well basis. So you can see here, we pay our pro rata share, we get our pro rata revenue, and we're returning that to our unit holders, that revenue off these wells with the least drag possible, both from the overheads that I mentioned earlier, as well as not having or having very low amount of debt in this product, so that we're able to survive the energy cycles as well as we have over the last 9 years. Again, never missing a distribution. So you can jump ahead here, Jillian. So what have we been doing in the energy business? We've been adding assets in weak commodity environments. And this goes back to the pandemic crisis of 2020, when things got very ugly in energy. And obviously, you're probably all sitting there asking, well, how did you skate across that significant event with the negative pricing on energy? The answer is we hedge a portion of our portfolio. As I mentioned earlier, hedging is a core risk management strategy that we undertake and have continued to undertake for substantial periods of time. So that allowed us to continue to meet our distributions in 2020. And what we understand as being in a commodity business is when you have those types of events, that is the time where you need to add assets. And we are a strong, diversified income fund, so we're able to raise money, and we were able to take what was an underweight strategy at that time, at being under 15% of the portfolio, and bring it up with acquisitions over the last 2 years to now its core target weight of close to about 40% of the portfolio right now. So adding these assets, as you can see, the production has jumped considerably. We have just recently announced last week another acquisition that will double our US production that is weighted to oil as well. So that's when I cite the fact that we're close to 3,000 barrels a day. That's not on this slide, and it will be added for next quarter. The other key component I want to mention here is that how we survive the cycles in energy is by having very low debt and very low operating costs. Our operating costs are less than US $10 per barrel of equivalent oil. So that's both on the gas and the oil side, and that drives free cash flow. So as you understand, we are in a cyclical environment, and our ability to maintain that 7% yield is there right through very low pricing of $40 to $50 that we've experienced over the last 9 years, sometimes even lower than that, but obviously I've mentioned the hedging. So that's an important feature. Low operating costs, very low levels of debt, giving you that income on a monthly basis and on a consistent basis. The overall portfolio overview in Q1, this is our actual asset allocation at the end of Q1. Lending strategy is a little bit overweight, or sorry, a little bit underweight at this time, but you can notice there's some cash on the balance sheet there. So we've been redeploying that and continue to work on redeploying into lending. Energy working interest is at 38%. So we have added in down markets that have upped our weighting. On the lending side, we have 24 arrangements, average loan size of just under $6 million, The average term is just under 2 years, and the interest rate is on the overall portfolio is 13%. Some of those loans were made in times where the interest rates were higher than they are now, although they've started to go up, as I'm sure you're all aware. So we see perhaps some reduction in our overall rate of interest, but still at 13%, we're quite healthy there. And then what's the security made up of? It's 19 first charge security positions. That means we are first in line and have right and title to the assets. The 5 second charges are generally in the real estate business, where we are securitized in second position. Obviously, to get our yields, we are generally in second position in real estate, but we do not do development. We are in second position on cash flowing, generally multifamily rental assets. So it is a much more stable sector, and we're comfortable being in a second position there. Equity yield is the smallest component of the portfolio, and that is made up of some controlling equity stakes in 4 subsidiary businesses. This is a transition area where we sometimes receive things like warrants or other equity considerations from borrowers that we record here, or in the case of a restructuring, where we enforce our security, restructured companies, any value of that company above the level of our debt that we receive in equity under restructuring is recorded here as well. On the energy working interest side, I think I've talked about this quite a bit, but over 1,000 wells across our core areas, which is Alberta, Saskatchewan, North Dakota, Colorado, and Wyoming. And this is again, with an average working interest across all those assets of about 3%. Sector overview, we're Alberta based and we're proud of our energy exposure. The oil and gas side, both on the working interest and any lending that we do there, is about 40%. Energy services is 15%. And then we become very diversified with manufacturer processing. Obviously, cash is a little bit high here right now at 11%. But as I mentioned, we've done some deals in Q2 that will take that down. And then we're quite diversified after that, focused on a balance of areas so that we always have real good options to put money to work, and we don't have to rely upon obviously a full or just on the energy cycle itself. So some of those include things like accommodation and catering for big infrastructure projects, film and media, where we're simply securitizing things like tax credits from federal and provincial governments, or pre-sales. A lot of films, when they're made, have pre-sales. We're not banking on films having a blockbuster box office or anything. We're only securitizing tax credits and or pre-sales in advance to assist in financing those films in getting produced. And in Canada, it's a fairly significant area of film and media. The equity yield model, currently, as we mentioned in the slide before here, about 12% of the portfolio. It's made up of 4 companies: Aspen Air, which is a Montana-based industrial gas producer. This is a company where we bought the debt from a third party in the business that was under a restructuring back in 2018. It was a successful restructuring, which is why we have, this is the largest piece of the equity yield portfolio, and it is included in our, obviously this is as a key driver here. So they produce medical grade oxygen, nitrogen, argon, produce obviously the oxygen being in heavy demand over the last couple of years, and now nitrogen being effectively sold out from this facility. So this is an example of making a distressed debt investment, and the amount that the company is currently valued, or our position is valued here above the distressed debt that we acquired in 2018 is recorded as the equity yield. Gator Technologies is a Texas-based energy service company, and it has been restructured in our fund successfully. Gator is doing exceptionally well, supplying the busiest areas in the US drilling sector with rental tools. And Sockeye and Red Rocks were the one restructuring that we undertook during the pandemic that are now in performing status. Makes up a very small percentage of the equity yield here, but it's a reflective of us taking action and restructuring a company into a performing loan when the original management team wasn't getting it done. So we are pleased that this has turned out again with David Hawkins, as I mentioned. He is a very active member of our team, and he does handle any restructurings that come that are required for us to do. If you're in high yield lending, if you're in the space we're in, you will have situations that you need to take action on. Anyone that is selling you a product that says they don't have any defaults, that everything is roses, is generally either very lucky or young into the existence of their fund, or is not being truthful. So remember to focus on the ability of companies to successfully take entities that are not performing and turn them around. Deal flow, the other lifeblood of any yield fund, obviously, as you're all aware, cash doesn't earn us any yield out there. So we are quite pleased with the deal flow we've been able to maintain, particularly over the last 2 years where we've had to go remote and not necessarily have the same type of contact and day-to-day routine. So in oil and gas, it's almost $100 million of deals we've done. In pharma, we've done 13 million, and in real estate, we've done 55 million. Those are available as well to future monies that we receive, as some of these are what I should say are revolvers or loans that we have put in place that are not fully drawn. So it gives us a home for future capital where we can add to an existing loan position. Thanks, Jillian. You can move ahead. So what makes us unique? Well, clearly this track record of private yield is admirable. We have a long-term track record of generating consistent returns. As I mentioned, since inception of over 12%, and we're very diversified with over 7,000 unit holders. So we're widely held and widely distributed throughout Canada. Energy working interests, I'm not aware of another private yield fund that incorporates this strategy. We like it because it's a hedge, provides us a quick payback, not a dissimilar duration to a bridge loan, and it gives us a very high current yield, but a long-term free cash flow and a proven strategy. And then lastly, taxation. Taxes continue to go up in Canada. That is probably going to continue for the foreseeable future with the tremendous debt that the federal government's carrying after the pandemic. So we have been able to maintain half of our distributions at a return of capital, and then half are taxed as income. So effectively, only 50% of your distribution gets taxed, and that gives you a much higher after-tax return in this particular product. Thanks, Jillian. Historical performance. This is a Class B unit. You can see that is, other than the difficult year in 2020 over the pandemic, obviously we have been able to maintain healthy rates of return, never going negative since inception. And obviously in Q1 22, get a tremendous return. And that's continuing into the second quarter here with our with some of our energy performance. But you can see that over the cycles that we've had, particularly in energy from 2014 through to currently, we've been able to maintain a strong level of performance, never drawing negative, and overall providing a very healthy since inception return on a Class B product, which is now the current unit that's available of 12.5%. I just point out on the bottom right, I mentioned award winning. We've won awards both in 2019 and then again last year from the Canadian Hedge Fund Awards for private debt, placing second place most recently for 3-year and 5-year return out of all products in Canada. And I think the only other thing I'm going to highlight here is on the governance side. I mentioned we have independent investment review committee. Sorry, I should be able to say that clearer. We have 2 members on our IRC, both Sabrina Liak, who I've known for a very long time, she originally was with Goldman Sachs, and we sat on a board together, and is now the CFO of Kits Eyewear. And then Dave Giebert, who has been with us for a couple of years, and he is a CA by background and has had numerous CFO roles at various private and public companies. They are referred any situations which could be construed as a conflict of interest. So that includes any kind of change in fee or expenses or anything that could be construed as a related party transaction. And it helps ensure compliance with our offering memorandum and obviously the focus of the fund. And I'll just keep that as something that I want to reemphasize, is that the asset allocation and mix of this fund has not materially changed. We have had the same asset allocation in this fund over the 9 years, adding assets in energy in 2014. So basically very consistent portfolio that these two individuals help us obviously oversee and govern.
Okay.
So I'm going to turn it back to Raintree here, as that concludes the total presentation.
Thank you very much, Jason and Jillian. That was a great presentation and very informative. If you have any questions or think that the Invico Diversified Income Fund may be a fit for your portfolio, please reach out to your Raintree Private Wealth Advisor. Thank you.
Thank you.